We're thrilled to have Scott Bradley joining us once again, Head of Sales and Global Business Development at the London Stock Exchange. And we're very happy because Scott is joining us from the studio at the LSE. The last time we spoke, Scott, you were unfortunately still in quarantine in your house. So we're so happy to see you, first of all, and to see that you're out of the house and everything's hopefully getting back to normal here. It's great to see you.
Thank you, Brendan. Thank you for having me, and good to see you as well. Yes, so exciting to be back in London and in the office today.
It's an exciting time as people get back to something that resembles normal. I want to touch a little bit on a recent announcement to start things off from the LSE, who announced, I guess it was last week, they're relaxing the free float rules to attract more quote-unquote tech unicorns. Why don't you explain a little bit on where this move came from and what the thought is behind that in trying to maybe get some more IPOs?
Thank you. Well, first of all, I think what we're referring to here is the news around the Lord Hill review, which was published in March. And it was a UK Treasury report, listings review report, actually, which was looking at how to improve competitiveness and attractiveness of the markets in the UK. Not just for, you mentioned unicorns, not just for unicorns, this is for all companies of all sizes. I mean, to quote the wording here, the report is a proposal of reforms to attract the most innovative and successful firms, help them access the finance that they need to grow their businesses, particularly in a post-Brexit landscape. So this set of proposals has been tabled, potentially to be brought into play by the end of the year 2021. Really looking to modernise the listing rules of the FCA, but also maintaining the UK's high standards of regulation. And some areas of focus of these proposals touch upon areas of looking to improve the IPO environment. So the ability to, or the recommended admission of dual class share structures into the premium segment of the London Stock Exchange market. Now, as we know, the premium segment is a segment which is eligible for index inclusion, looking to reduce the free float, as you mentioned, which is currently at 25% free float. A recommendation to perhaps reduce that down to 15, or to have more flexibility on a per company size basis, basically looking at more appropriate measures of liquidity. That's what the free float was about, was liquidity coming to the market. And I think there's a realization that a well-formed, robust market can still occur without that 25% free float requirement. So potentially moving that down to 15%, or having more flexibility, as I said, and agility around other measures. Also some potential changes around the trading of SPACs in the marketplace as well. But it touches upon the prospectus regime as well, and looking to simplify and improve the prospectus regime. It looks at forward-looking information within the prospectus as well. Historically, it's been about a look-back review over companies, and potentially some more ability to have a look forward at companies coming to IPO on the market. And also the use of tech. The use of tech, particularly as it relates to the retail segment. Looking to try and attract more retail activity in the markets is an important feature of the UK strategy, and that's something that UK Treasury realises as well, and is looking to make those proposals to see if improved use of tech can be utilised to bring the retail market closer to the capital markets in the UK. Now, that's actually something that dovetails quite nicely, ironically, with our interest as the London Stock Exchange in primary bids. We have a stake in primary bids, which is looking to help democratise the access to the IPO markets for the retail market through digital apps and platforms. So that gives you a bit of a review of what we're talking about there. But just very, very briefly, as I was saying to you, this is not just about unicorns, as you mentioned. It's about companies of all sizes. And H1 in 21 has been a stellar year for the primary markets in the UK. 73 markets by the end of July IPO'd, which is the the best start to a year for 7 years, 40% of those tech companies, actually. So, Wise was a great example. There was a direct listing of Wise only a month ago on the London Stock Exchange. So it's really talking about that stellar performance in light of post-Brexit, and also producing an exciting environment of a lot of different companies coming to market for investors to trade in the UK.
I want to make sure we touch on some. You mentioned a few things there, a few important things, including liquidity, Scott. And we're getting into the summer months. We're getting into August specifically, which is renowned globally as probably the slowest month of the year on the trading side of things. Talk a little bit about how volumes heading into the summer have been on the LSE, and what are you projecting to see throughout the remainder of the summer?
Yeah, so seasonality takes effect, and I think this year more so than last year, for sure. So over the last couple of months on a pan-European basis, we've seen a 3 to 5% decrease in on-venue activity taking place across all markets in Europe. So on-venue activity is about 45 billion euros a day across European venues. What we are actually seeing is a decrease during these quieter periods in lit trading activity, lit continuous trading across venues, including on LSEG lit markets in the UK. But we are seeing a slight increase in dark trading venues. We're seeing a slight increase in periodic auctions, but also SI. SI activity is increasing. And if we look at those liquidity providers in the market, the non-bank liquidity providers, we see that they are currently about 4% of the total European average daily value traded, with dark pools about 10%. So overall, the net is a decline, but we're seeing a greater decline in the lit continuous, which quite often happens this time of year as people do start to go on vacation and the holiday season kicks in.
When last we spoke, Scott, we discussed the post-Brexit approach as far as Turquoise is concerned, the LSE's alternate trading system. Touch a little bit on how that has played out as far as the rest of Europe is concerned throughout different marketplaces, and give us a general update here on Turquoise.
Yes, certainly. So running into Brexit, as you know, through European share trading obligation and other regulatory headwinds, there was a requirement for venues such as Turquoise to open up European entities, and we successfully did that in Amsterdam. So Turquoise Europe was launched under the regulation of the Dutch authorities, and we have seen a very successful wholesale shift, a once-in-a-market lifetime wholesale shift in liquidity for European trading activity onto those European venues. And Turquoise Europe now trades over 99% of the European business we see on our Turquoise platforms. So a successful migration across into a new trading entity, an entity in Europe which offers exactly the same trading functionality as investors were experienced in using and having success with in the UK. So dark block trading, conditional trading, periodic trading, lit activity, etc. Dark lit sweep functionalities, all available on the Turquoise Europe platform. So we saw a shift in the liquidity, and in fact we've actually, because of some liquidity provision scheme enhancements that we've been making in Q1, we've actually seen a slight increase in relative share of the lit trading activity that Turquoise is enjoying in Europe. So all in all, a very successful and very positive story to that post-Brexit migration on Turquoise. More broadly on the London Stock Exchange platforms, another very successful year so far for our ETP business. We've seen over 160 new issues come to market, half of which in the ETFs, half of which ETCs. Half of the ETFs that have come to market have been with an ESG focus. So again, that's a trend we're continuing to see on London Stock Exchange, which is a real home for the green economy investor. And so that's about a 16% increase in turnover on the London Stock Exchange in the ETP space versus H2 last year. So we're seeing positive moves post-Brexit. London Stock Exchange, fantastic, stellar start to the year with IPOs, and that liquidity provision coming from our secondary markets activity continuing to prove strong and growing as we enter into Q4.
We love having you on, Scott, to highlight the opportunities outside of North America in general and throughout the European landscape. Scott Bradley, Head of Sales and Global Business Development at the LSE. It's always a pleasure. It's great to see you, as we mentioned. We look forward to an update in the future.
Great to see you. Thank you very much.
There we go, guys. Again, Scott Bradley, Head of Sales and Global Business Development at the LSE.